If you're in a position where you've been assigned stock or you just simply have stock that is now underwater and you're looking at selling covered calls below your stock's purchase price, you have found the right video. Of course, though, this is not financial advice. This is just what I do and am doing. Don't copy a stranger's on the internet. That's not a smart thing to do. I would love, though, to invite you into the 50K Club because that's where this video has originated from. Someone asked, hey, how would I go about selling covered calls? I'm underwater a little bit. What different strategies do you have? So this video was born. We talk about all sorts of stuff in the 50K Club. It really has become such a community where everyone's helping each other. There are so many smart people in there. There's 102 of us now. So if you're looking to join a community where it's not just about trading, but it's about learning new strategies and it's about helping each other along the way and just not feeling like you're alone, come check us out in the 50K Club. With that said, let's jump on into it. So firstly, I want to start by covering the mistakes that a lot of people make when selling covered calls below purchase price, what to do instead, and then the risks and hidden traps, because of course there are some. All of this though assumes that you believe the stock still has potential and will return to your purchase price. If that's not a belief you have, and if it's not I'm hoping that it will, but if fundamentally something has changed and you're in a stock that realistically isn't going to recover, it's time to pull the plug and get out. So all of this assumes that the stock you believe will return. So mistake number one, selling your call too far into the future. We want to keep our covered calls nice and tight in expiry date. 1 week, 2 at the absolute most, but ideally we're just doing these week to week so that we can maintain control. Because of course, as we know, prices can fluctuate so much in a small period of time. Mistake number two, selling too far below your purchase price at the wrong times. There's a time when it's safe to do so. There's a time when it's not safe to do so. I'll cover that with you. Mistake number three, waiting for a green day. Saying goes, you'll receive more premium on a green day for a covered call. However, red often means more red, often means more red and more red. And if we're waiting for that green day, it's actually increasing the risk that we're putting on the trade because the red means our covered call goes into profit straight away. I'm going to show you that as well on the charts, but waiting for a green day for me is a no-no. Number four, waiting too long to roll. The further in the money our covered call gets, the harder it becomes to roll for a short period of time. That's when we end up having to roll out months and months on end, which I don't like to do if I don't have to. Mistake number five, taking profit at 50% if the stock is still going down. Your covered call is protecting the losses on the shares. And as soon as we cap the profit from our covered call, we're opening up for the full loss, dollar for dollar loss on the stock. Whereas having that covered call was a bit of a cushion on that. So this is a mistake I've only just added recently after I've seen a lot of people, excited to take a covered call profit at 50%. Yes, it's exciting to take profit, absolutely. But the flip side is you're actually expanding the loss on the stock itself. So here's a couple of numbers that you need to know first. Number one, your entry price. And all I mean here is either what you bought the stock for or what it was assigned to you at. We're not including any premiums. So if you were assigned the stock on a sold put, we don't care about the premiums. Then know your safe price. So a lot of people refer to this as your cost base, and that's the stock purchase price less premiums that you've received, right? So you need both of those price. What was your purchase price and then what's your safe price? And then we want to identify the current chart activity because this is going to tell us when and where we can sell our calls. I want to take you through an example. Now, I shared last week, the week before, that I'd bought more shares of Credo. I had a previous lot called away. So I bought new shares in Credo at a purchase price of $245. Now my safe price is 215. So I want to walk you through a few of the trades that I've placed on Credo that have helped me to basically keep this at a break-even trade, even though my stock is technically $3,000 underwater. So let's come into the charts and have a look at this. All right, so I've got here my Credo chart. I've got my levels marked out. So 245 here being my purchase price and 215 being my safe price. Now, I actually have an open call at the moment at a strike of 230. So let's make that a different color altogether. Okay. Here's what I've done. So I've got my trades all here. So I bought on, I buy June 30, which must have been actually the 29th, Monday the 29th, because I live in the future. So this day here is when I bought, and I started selling calls on it straight away. Okay. Obviously, sell it, it expires, or I close it, sell it, it expires, it closes. This is all fine and normal until we start to drop down below my purchase price. Now, there's a couple of moves that I made on this run down to help me get as much premium as I have. So right now, this entire trade is basically at break even. So my Credo position is in a loss of $3,079, but so far I've got $3,055 worth of covered call premiums. So I am keeping like balance, if you will. And this is why there's a couple of trades in particular. So on just getting my dates for you. I want to take you to the 14th, which would have been the 13th. So I had a $250 call. I rolled it all the way down to 240, right? Why? Because I saw that it looked as though we were breaking down. At 240, I knew as well, do you know what? I can roll that if I need to. If I'm wrong and we come back up, 240 is only $5 away from my purchase price. I can roll that back up for another week. It's no big deal. So I kept the same date. So I kept my expiry date, actually it was for last week, the 17th, and I just rolled my strike down. Why? Because I wanted an extra few dollars just in case. And I received an extra 8, 9, 10, 11, 12. I received an extra don't mind the fingers. I received an extra $400 from rolling that down. So that's adding to my little safety buffer. And if I needed to roll up and out for the following week, I could have done that, right? Come the 16th, Thursday, I could see that, you know what, that's going to expire worthless. We're not getting anywhere near that 240 level. So what I did was I actually closed the call that I had open expiring last week, which technically means I rolled it to this coming week, which was the 24th, and I rolled it to 230. So I just kept rolling that down. I've received $560 odd for that roll. So right now I'm looking at, yes, I'm below my cost base, but I want to show you why I chose that strike as well, right? So I chose that on the Thursday the 16th. The reason why, number one, I was happy to place the trade below my purchase price is because it looked like we're probably going to come back down and test this EMA, right? Oftentimes what happens is when we lose one moving average, we come and test the next. When we lose the next, we come and test the next. And technically that's what happened. We didn't quite get as low as this 150 here, but we got kind of close. So I was happy that if I have a covered call that is above the moving average that we just broke, when I'm expecting that we might still come down, that to me was an okay trade to place. Knowing that I can still roll this up to my purchase price and out by a week, probably two, if need be. And this trade I'm still in, right? So then the next question becomes, well, when would I roll that? I would roll that as soon as it looks like we're about to break through this EMA. So today it didn't look like we were going to do that. We got close to it, we come back down. But if closer to the end of the week, we're looking nice and strong through here, some nice big green candles, maybe we even touch the 230 mark. I mean, realistically, for a stock like Credo, this moving average is at 225. 230 is not that far away. So as soon as it looks like we might start to touch that, I'll roll that up and out to next week for another credit. Now this here, of course, is all still quote unquote safe because everything is still below my safe price. But it's not always the case. And I want to take you back in time to when I was selling below my safe price. So through here, and this will bring in a couple of the beware tactics also. I had bought my shares at 130 and we got down all the way to this sort of $90-ish mark, $92. So when we're trading well and truly below, I can't remember my safe price, but let's assume it was probably like around here. Let's make that green for safe. So I was selling covered calls below here at some point in time, right? The timing of these is super important. What I'm looking for is rejection from these moving averages. So when we came up in the stochastic RSI and we started to reject here, and then we started to reject through all of these levels, that was my sign that the next most likely move is down, right? Same through here. We rejected. That's my sign that the next most likely move was down. So when I'm selling below, well, actually that was probably not even below really, was it? Because that was still at my purchase price. So I might have been lucky and I was still selling at my purchase price. But what I'm looking for is when we're rejecting, because when I'm selling a call that is below where I've purchased shares at, I think I probably had I had another group of shares that were maybe like 145. So those would have been the ones that were actually selling quite significantly below. I'm looking for the next most likely move to be down because I don't want the strike breached unless they're going to be sold in a profit, right? When do I stop and when would I not place a covered call trade? When we are, see how through here, we are very extended from this next moving average, right? That's quite a distance away. When we're that far extended from the moving average above us, in this case, the 20, we always come back up to test it. So I'm looking to sell my covered calls when we are rejecting from the moving averages, and I'm absolutely looking to just wait when we're far extended from these moving averages. Okay. Now what happens, this is the part that we need to be aware of, is exactly what happened through here. We had this massive gap up, which seemingly was for no reason, right? There was reason behind it. They did have an announcement that was, of course, the reason why I was in the trade in the beginning, but I didn't expect an announcement here. I was waiting for it to come out in earnings here, but this happened. So for my shares that I'd bought at 130, it was fine. I was able to just roll up, and what I did was every week I rolled up a little bit. I got a little bit more premium, and I just kept rolling to the point where I couldn't get a roll that was worth it anymore. So I think it was when it gets this far extended, rolling, there's not hundreds of dollars in it anymore to go out much further. So I ended up just letting them be called away at, I think, maybe like 150-ish, 160. But it was the ones that I was selling my call below my cost basis, which was I think around 145, that I got caught out on, because I had so much rolling to do before I got back to that break-even point. So they ended up being sold in profit. However, this date here was April. I think it was June that they were called away. So they ended up being called away in June, and down here rather than up here. So yes, in hindsight, as soon as that strike was breached, I could have bought it back, my sold call, and I could have ridden this up and had huge profits. But hindsight is a beautiful thing, right? The risk in doing that is that you buy that call, you take that loss, and then the stock reverses and never comes back. And I've seen that happen time and time again as well. So my rule of thumb now is always just roll until it doesn't make sense, and then just let them get called away. Let me show you an example. I'm going to use PayPal as the example of, except for this, right? Except for this jump up here. But PayPal as an example of buying back. Actually, it's a bad example now. Let's go to Palantir, because I know a lot of people did so in Palantir, right? Now I've got lots of drawings for other examples I was doing of this. Let me clear this, right? So a lot of people got caught out with PayPal, with Palantir through this move here and through this move here. And they had covered calls that were maybe, let's call it at this sort of 140 level as an example. They bought back the call thinking, we're going to go up now, we're going to go up. So they bought back that call at a loss. Their stock purchase price is still all the way up here. And now they're just further in the hole because we didn't continue the run. We come back down. Same with here. The same thing happened. People were like, oh my God, my covered call just got blown out of the water. I will just buy it back. They've taken the loss, and now look where we are. So for me, that's why I like to keep the expiry dates tight. It's why I like to still always be able to potentially roll up and get a roll to my purchase price. Let me just show one final little trick on how to do that, and that's checking rollability, right? I've done a rollability video on sold puts before, but covered calls I find equally as important. So if I come into bar chart and I've got my Credo options chain up here, what I'm looking at is the first in the money call, right? So let's pretend we've got our sold call. It's just gone in the money and we're like, oh, I think I need to buy this thing back because I, want to roll it, right? So our first in the money would cost us, let's call it $15 to buy back. We need to go into the future and see how far up could I potentially roll this if I had to. So if we go out 1 week, and look for where's $15 on this options chain, and let's call it around about 220. So we could roll potentially $15 up. I mean, depending on these strikes, between 15 and it's 10, between 10 and $15 up, right? And get our strike out of harm's way. So if I was looking at the chart, and let's pretend I needed to roll because this is at the money and I needed to roll up by $10 thereabouts, 10 to 15. It's going to take me to kind of here. So I can kind of get a feel for, oh, I'd be still so far away, you know? So then I might come out and look at the following week. Where's $15 the following week? Okay, that's great. That's looking like it's $2.30. So that's $20 difference. So if I had to do that, $20 difference is going to take me up to here. Actually, it's a bit of a bad example given that this is literally at the money now, but pretending we were here, right? Let's pretend that we were going from our $2.30 and we had to roll up $20, would be like, okay, that could get me to my $2.50. So that would get me out of harm's way, back into profit. What's that? 2 weeks out. Potentially, if my strike gets breached and I want to roll back to safety, I can roll back to an out of the money call by going out 2 weeks if I needed to, right? So that's what I look for here, is what's the likelihood that I would be still stuck underwater. Right, let's go out. I've gone out to a 39 DTE now. $15, 270. So that is now $60 from current trading price. So if I had to roll my 230 and I could get, call it $60, that would take me up to 290, right? 230 plus 60, well and truly past my purchase price, right? So I hope that part makes sense. I know it can be a little bit confusing trying to do that math, but what I'm looking for is how far would I have to roll to get something that would potentially put me back into profit if the stock was sold, right? If this was still well and truly, let me use past numbers, right? Let's pretend that this up here is my break-even price and a roll would only take me, I'm selling down here, and a roll would only take me here, or it would only take me here, or it would only take me here, right? I want to know how far into the future I potentially have to go to get back above this price. Because if this takes 12 months, then I'm going to be a little bit concerned, because if we get a run like this, I don't want to be stuck in it for 12 months. So it's just thoughts to have. I know that that's probably a lot of thoughts to have, but they're the things to try to keep you as safe as possible and to ensure that you have a way out that doesn't always involve, I've got to buy it back. Because if we buy it back and then it drops, then all we've done is add to our risk of owning that stock, because we've just increased how much we need to sell it for, as opposed to reduce the risk of that stock. So I hope you found this helpful. Let me know if you have any questions on it. Let me know if there's anything else you'd like me to cover in relation to selling covered calls, whether it be below your purchase price or just selling covered calls in general. I'm very happy to answer them for you. But this is a strategy that I like to do if I've got covered calls, or not covered calls necessarily, but a stock position that's going against me that I then want to sell covered calls on. So I hope this was helpful, and I'll see you all in the next video.